Greetings and good day. Mark Mackler, our Vice President, and I are pleased to welcome you to our PLMA Risk Mitigation and Sourcing webinar. It should be noted that we have also received many requests to present individual webinars to leadership teams on an individual corporate basis. We'll be pleased to discuss this together with you as well. We're looking forward to a very positive meeting and discussion. This is an industry cross-section of registered webinar attendees who have either reached out to us and or will join the webinar. In the marine sector, we've served this sector for over 25 years in the United States, very successfully on a broad range of products. The rapid prototype sector, we've also served this sector for the last 10 years, and this area continues to grow here in Asia Pacific. The electronic sector, while it continues to grow, it's becoming more diversified across multiple countries here in Asia. Particular growth is occurring in Vietnam and India. The aerospace sector, we have served Airbus in Europe and our 24 operating divisions. On automotive components, we've served major automotive component producers in the USA with high-quality components out of Asia Pacific. On private equity, we worked with over 13 private equity companies and helped them be successful with their holdings. The leading turnaround companies in America have reached out to us globally, and we've assisted them with their turnarounds, both on operations here in Asia as well as in the United States. In the LED sector, we've been involved in this sector for over 8 years. It continues to be very strong out of Asia. The medical device sector continues to grow, not only from a demand in the U.S. side, but also here in Asia Pacific. Global consultancy companies have reached out to us and asked us to assist them with their programs here in Asia as well. From a material handling standpoint, examples are we have set up sales for virtually all the major forklift companies here in China and in Korea, as well as aerial work platform companies. Glass and hardware area, this area is expanding, and we're working with the leader in the United States. The equipment manufacturers, we've helped not only from a sourcing standpoint, but also marketing and sales. So we will have attendees from these various groups come in to join with us during our presentation today. As an introduction to PLMA, many of you have worked with us over the years. Some of you are new to us, so we provide a short background and history. We have been located in Asia for over 30 years. We're an American-owned company, and we do provide turnkey assistance on a combination of services, including best cost country sourcing, competitive intelligence, market research. We provided due diligence in many cases on operations here in Asia over the years, and of course sales and marketing of Western products and services into Asia. We work with a who's who roster of industrial, private equity, and turnaround clients, and we're available as a team to our customers in the USA, China, South Korea, and across the world on a project support basis, 24 hours a day. We have a highly technical firm, including engineering, sourcing specialists, and sales, market, and research professionals. As noted, we have assessed 1,500 plants in Asia, actually over 1,500 plants in Asia over the years. And we appear in the organizational charts of many of our clients as a strategic partner. And we have long-term engagements of up to 25 years with companies across the world. A high percentage of our business is repeat business, and that's both for exports and imports. And we work on behalf of our U.S. and European clients, acting as their eyes and ears on the ground. And this is particularly important during these times. And in fact, in over 60% of the cases, our clients have either IPOs or plants on the ground in China, yet still reach out to us. We can assist you with your alternative source of supply activities in Asia, North America. This would include onshoring, also in the U.S., or reshoring to the U.S., or nearshoring in Mexico, of course, as well as here in Asia Pacific. We benchmark new suppliers. We manage the RFI, RFQ processes. We work with you on the PPAPs, run at rates, total supplier relationship management. Utilizing our sourcing engineers and metallurgists as technical interface with the suppliers and working closely with your organizations. We can also help with options around the change of country of origin and moving of tooling and equipment should it be necessary if you relocate your supply base. Again, we support our existing suppliers and new suppliers on relationships both here in Asia, North America, and in Europe. We have quality engineers who can conduct quality audits and manage ongoing quality support initiatives. We negotiate with the leadership teams of the respective companies, and it's critical to understand the cultural issues and mindsets in each area of the world as you're working through negotiations and future partnerships between the companies across the globe. There are options available on non-tariff countries that are attractive to you from a cash flow standpoint and also on payment terms and conditions. And we can provide a view of your competitors' sourcing shifts, and we have a broad-based access to databases to help you locate new potential suppliers. One must consider carefully key considerations when preparing your sourcing and marketing strategy. It really starts with, why are you doing this to begin with? Is it herd mentality? Is it focused? Have you detailed information to support your assumptions? Is there a proper return on investment with these opportunities? And are the countries and suppliers that you are considering potential long-term suppliers to your organization? As part of this, you have to look at the various currency activities within various geographical regions of the world. The GDP growth is indicative of the trends, but you have to look at that GDP growth versus the debt to GDP ratios, because GDP can be growing, but the debt can be going out of control as well. Raw material trends and availability. This is critical, particularly where you have high-spec materials to be used in your products. What are the tariff implications today, potential implications tomorrow? Can you appeal with the Commerce Department and Customs such that the tariffs can be reduced on your products? And we can help you discuss this as well and consider the various options. What are the countries of origin and the various options available to you? What is the complexity of parts that you want to source? And how best will the respective companies in those respective countries be prepared to support that complexity with the highest quality products? Labor availability and cost today, tomorrow. This is also very important. Logistics implications, not only globally, but internally within certain countries, should be carefully considered. The geopolitical risk today across the world has substantial implications and must be carefully considered as well. Are you looking at trying to generate these activities to add cost savings and margin improvement? Have you carefully studied these products? Have you Have you gone out and benchmarked the respective suppliers? Have you gone in and audited the sources? All of these functions can be considered to support your efforts. What is the impact in your current markets? If you're currently supplying markets in China and also you're moving out of China at the same time, what are the implications there? A good example is Apple is moving quite a few of its components and the supply chain, if you will, into Vietnam, into India, and other countries, which will reduce the amount of products purchased here in China. How will this affect both them from a market standpoint of their products here, the supply chain, and the respective costs within China also? Now, again, we encourage you to look at the broad range of opportunities, starting with your current suppliers, how you reduce their costs, improve their quality, reduce, if you will, their cost of ownership, new suppliers within the theaters of operation you're in, new countries that you would add as part of your supplier base, Asia as a whole, the overall considerations here, North America, onshoring and reshoring activities as well. One must also carefully consider new currency alliances that are developing around the world and the potential influence on global trade, dependence, coupling and decoupling of relationship. The BRICS relationship, Brazil, Russia, India, China, South America, will create a formidable, if you will, currency base. Much of this trade would be conducted in RMB currency, and they've also set up an alternative to SWIFT to be used. One must also consider carefully the current and future changes of geopolitical events as well. The shift in global currency reserves used in bilateral trading will impact all economies in the future. Now, as we look at the China one-year currency curve, I'll make a few comments here, and these are very important. China wants to stabilize the valuation of the RMB currency since it is now expanding agreements across the globe affecting global trade in oil, gas, precious metals, raw materials, its Belt and Road initiatives. And this will add confidence of other countries to continue trading in RMB and growing their reserves in RMB instead of US dollar reserves. So their objective will be to try to stabilize their currency as early on as possible. Now, China has very large US dollar foreign exchange reserves, of course, held in the US. However, China, Japan, Russia, and others have been reducing their US dollar reserves held in the States. This is sometimes an indicator of future events and must be monitored. These countries are also hedging against potential sanctions and impact on currency given the huge spending deficits and printing of money in the USA, where the debt to GDP ratio is out of control. And these events, tied with the impact of the sanctions, will escalate their direct impact on the financial markets today, tomorrow, and in the future. The high rate of inflation in the States has increased the cost of borrowing and reduced effective return. Thus, there will be additional movement of currency reserves to other holding vehicles outside the US dollar, and investments in view of the instability of the US dollar with huge deficits in place, potential sanctions on other countries' currencies, and including the risk of freezing currency reserves and or the ability or inability to trade through SWIFT. And thus, what you're seeing is the emergence of the currency and strength with the RMB currency. Now, over the last 12-month period, from low to high, as you can see, the Chinese currency is depreciated by 5.45%. There have been peaks and valleys during that year. And again, I think they're going to try to stabilize this such that other countries will begin trading to a higher extent in RMB currency. I think a good example of this is Saudi Arabia's recent agreements with China. And China has been able to negotiate not only lower prices for these various commodities with Saudi Arabia, Russia, and other countries, but the ability to trade in their own currency, RMB. Now, this 5-year Chinese currency chart, as you can see, there have been some wild swings in currency over this 5-year period of time. During this period of time, the currency has changed from low to high, if you will, during that period of time, 9.16%. Again, it's believed that China will try to stabilize the currency, give an emphasis on making the RMB a major trading currency. Now, the US dollar used to enjoy 80% of the global currency transactions. Today, it's probably close to 60%, while the RMB and other currencies are a much smaller amount. The one that will grow the fastest in the future against the US dollar over a period of time will be the RMB. Now, as we look at a 1-year chart on the Vietnamese currency, it's evident that it's been reasonably stable, except for one section of the chart from September through December. But the currency itself was depreciated by only 1.65% over the last year, as shown on the chart. When you look at the Vietnamese currency over the last 5 years, it's depreciated by 2.85%, and thus has been one of the more stable currencies in Asia over the 5-year period. This is an important consideration both from a marketing and sourcing standpoint, as well as a foreign direct investment standpoint. As we look at the Indian currency over a 1-year period of time, from December 2022, it has been reasonably stable since last September. However, the Indian currency has depreciated by 6.88% over the last year. And one should note that the Indian currency is depreciated by 22.71% over the last 5-year period. Now, this is an opportunity for those companies who are purchasing goods from India, because as the dollar gets stronger against the Indian currency, obviously every dollar you spend for dollar transaction currencies will buy you more goods, better return. However, India is also part of the BRIC New Currency Alliance with China, and India is also developing other currency relationships as well. This is the 5-year chart again, and as you'll see, the 22.71% depreciation, if you will, loss of value versus the US dollar during that 5-year period of time. And obviously, as a result, as I mentioned, the US dollar's purchasing power versus the Indian currency has increased over this period of time. However, the rate of growth in the depreciation has been reduced. GDP, everybody thinks about gross domestic product trends that are given across the world. Obviously, one of the questions is how valid are those numbers in each of the countries that they're putting out there. However, it's an indicator of the country's current position and potentially, from a trend standpoint, future position. However, one must also consider the debt-to-GDP ratios. I gave a speech in Thailand, and this was a major source of the discussion there on debt-to-GDP and the concerns of countries in Asia, but also, of course, now the major concerns with the out-of-control spending and printing of money today in the U.S. Now, this chart shows International Monetary Fund's projections for the GDP in 2023 of 1.6% for the USA, in 2024, 1.1% growth. Mexico is shown at 1.8%, 2023, and 1.6% in 2024. Given the large trading relationship between Mexico and the U.S., they are somewhat linked together in their growth patterns. This is not to be unexpected. Now, as we look at other countries, Korea is mentioned here, and I will mention during this presentation that a large percentage of the participants had asked to be focused on China, India, and Vietnam. But I will also mention that our relationships in Korea go back 30 years. The companies who have supplied us out of Korea and continue to supply us have done a great job with high quality, on-time delivery, and leading edge abilities to upgrade products to the market. In Korea, they're highly dependent on their exports as part of their GDP. The forecast this year was 1.5%, 2024 growing to 2.4%. Taiwan, obviously, as a province of China, the 2.1 and 2.6% depends to a great extent on geopolitical events. China's growth was forecasted in 2023 to be 5.2%, and in 2024, 4.5%. India, as you'll see, has a very high growth projection for 2023 of 5.9%, and also in 2024, 6.3%. So India continues to grow, and you're going to see in future discussions in our presentation, from a foreign direct investment standpoint, India is also the beneficiary of this as well. Vietnam comes up in almost every discussion with companies where they want to source in Asia, and their focus is, do they stay in China? Do they expand their business in China? Do they move portion of their business to India or Vietnam? Vietnam is projected to be at 5.8% 2023 and 6.9% in 2024. And we're going to talk about foreign direct investment for them as well in a minute. As noted from an FDI foreign direct investment standpoint, and this is particularly important as China grew over the years to a world power, both economically and otherwise, a large amount of foreign direct investment came into China. And this helped accelerate that growth. And so in this chart, you're going to see from left to right, countries where the foreign direct investment during this period of time, admittedly, this was 2015, 2020. The latest numbers will be coming out shortly. What it shows in India, it's one of the top 3 countries where foreign direct investment was coming in. It also shows Korea and Taiwan, where there was foreign direct investment coming in a positive way. It also shows Mexico during that period dropped off, Vietnam dropped off, and China and Hong Kong both had major drops in their FDI. And these are government provided information. Now, going forward, I think you're going to see changes occurring where the foreign direct investment will increase in Vietnam, India, Mexico, and those countries which can provide a high rate of return to the investors, both in the technology and investment of the monies. Again, these trends will vary based on geopolitical events, thus are not easy to predict. I'll now provide a background discussion on Vietnam. As noted in 2018, the trade war between the U.S. and China, the subsequent lockdown with COVID, affected the foreign direct investment in Vietnam. It also affected the trade by and between all the major countries. Now, Vietnam is becoming selected as a manufacturing opportunity and is becoming very competitive to China, in many cases with lower prices. However, I should note there are also instances where, for example, China companies have put joint venture companies in Vietnam, have brought the higher technology end of the products into Vietnam from China and then manufactured and assembled the products in China. However, one has to consider the country of origin implications of that should it be sent to the U.S. I would also note that Vietnam has been a beneficiary, a very heavy investment in chip and other manufacturing electronic items of all the various major players around the world in the country. This is a major growth area for them, will continue to be. Obviously, footwear, textiles, garments have grown significantly, and the machine tool emphasis is beginning to grow as well in the country. The government has prioritized infrastructure development to facilitate economic growth. Thus, one must carefully consider the regions of the country in which to put manufacturing plants or purchase the products from. Now, as I noted before, IMF projected the real GDP growth projections to be 5.8% in 2023 and 6.9% in 2024. Obviously, that's very positive. One should also look at the imports and trends. And from January to March of this year, the exports to the U.S. Totaled $20.8 billion US dollars. Again, a large portion of this are in their top three exports, which is $12.7 billion, which includes computers, electric parts, spare parts, components, telephones, machine and equipment and tools, etc. Vietnam added $2.35 billion in foreign direct investment in March, bringing its total in 2023 to $5.46 billion. This is 60% of the FDI Vietnam received over the same period last year. Again, the four key clusters are garments and textile, automotive sector, electronics cluster, food, beverage, and feed processing clusters, if you will. This map reflects the three major manufacturing trading areas in Vietnam. As you can see in the north, Hanoi, in the center of the map, Da Nang, and in the bottom quadrant, Ho Chi Minh City. Now, I have been to Ho Chi Minh City. I've been to Tam Kỳ, Duc Pho, Chu Lai, Da Nang, Cam Ranh Bay, and many of the various cities in Vietnam. And the key is having the right partners when you're developing business there, understanding the trade laws, opportunities, and doing complete risk mitigation assessment, as you would do with any country and as you would do with any new supplier. But there are significant opportunities in Vietnam. They will continue to grow. So this chart reflects why one should consider Vietnam as part of your diversification strategy in Asia. Yes, their currency has been reasonably stable. They've had foreign direct investment coming in that will increase. And they have a stable economy, and they have a good GDP growth rate. Their political system appears to be reasonably stable at this time, and you have ready access not only for the sale of goods into Vietnam and or the sources of supply from Vietnam and South Asian markets. Many countries are using and companies are using Vietnam combined with their mainland sources, which typically are those companies in China, but we've also seen, of course, companies from Korea and other companies who are expanding rapidly, but utilizing the technological advantages, process control capabilities, quality systems that they can bring in from their home major corporate centers. Their workforce is young, it's skilled, their learning capabilities are very good. They're very proactive on free trade agreements. They have many agreements around the world, and they've made this a priority area to make sure that's set up. Again, the foreign direct investment continues to grow. The zones that we've reflected there, each area of the country has certain strengths for certain commodities, but they have well-developed economic trade zones, and they have the rapidly rising middle class, urbanization, and so forth in the country. So there are a lot of very positive factors. This chart, the sampling of Vietnam's exports year to date, and I'll take the column in March. As you see, the United States was the leading country buying Vietnam's products, followed by China, Korea, and Japan. But the U.S. is a leading buyer of products from Vietnam today. Now, as we look at this chart, it's a sampling of Vietnam's imports. And let's go to March again. As you can see, the largest importer and the sampling of Vietnam's imports is China. And Korea, also they import quite a few goods from, as well as Japan. Now, in some cases, these are goods that are imported to become part of final products. In other cases, it's to utilize in the country. Obviously, they have to support the growth of the middle class and urbanization aspects. But as you can see, China, Korea, Japan are areas where Vietnam is importing goods. America's imports are quite a bit lower than these other Asian countries. Part of that's logistics costs, part of it's the strength of the dollar, part of it are the trading relationships and the ultimate end markets for the products. This chart, the foreign direct investment in Vietnam through March, is very important. As you can see from the trend, Singapore had 75 projects with foreign direct investment in Vietnam. They were one of the top ones. Hong Kong, 42. Republic of Korea, 81. And China, 77. So you would take, in China's case, of course, and add China, Hong Kong, and Taiwan together. So the three combined would be the largest. The U.S. only had 20 total in that 3-month period of new projects going into Vietnam with foreign direct investment. So the Asian countries continue to invest heavily in Vietnam. This chart and the backup information, of course, is important to be considered. And these are exports by category from Vietnam. And we're looking particularly at March here, but as you can see, the computer category, electronic category are major areas. Also, you'll see equipment, tools, and that covers a broad range of sectors, is significant. And of course, textiles, footwear, and other products continue to be of a major order of magnitude. Their wood products have always been significant, and they've seen growth in this area in March over the previous period. Iron and steel, some exports there. So one should consider the trend analysis by area because you'll be looking for certain manufacturing quality capabilities and trading capabilities by category of the goods that you're considering. So as we look at Vietnam's takeaways, there's little doubt in our mind about the eventual future for Vietnam. I've been there. The people are very focused, they're resourceful, and the record shows control, both from a FDI standpoint, monies are coming in, from a currency standpoint in their economy, and they're also, as you can see, growing their businesses and their exports across a broad range of sectors. The non-electronic areas, in those cases, many times the principal end products are sold from Vietnam or sold within Vietnam, but certain of the highly complex parts are still being produced in China, Korea, or other countries and brought into Vietnam for assembly. And many of these programs offer a high rate of return. One has to consider the rate of return versus the risk versus the return on investment, and of course the capex that's involved as well. China and America have had long-standing trade together. Obviously, there are a few challenges at this point in time relative to potential sanctions relative to tariffs in place. One would hope that the countries can find positive ways to move forward across a broad range of issues. So this WebEx is not intended to be political in any way, but to provide an update. Observations in the China update. China is rebounding strongly following their reopening, following the COVID lockdown going away. I would mention that I had 150 tests over that 3-year period of time, not because I desired to have them, but they were mandatory. And within 1 week after they opened up, after the country, I got COVID at that point in time, but it wasn't difficult at all. But noting that we don't see a lot of issues in that respect at this point in time. Every country has a few cases here and there. The first quarter, the GDP grew 4.5%. That was above forecast and was the highest since the first quarter of 2022. That's positive. There was double-digit export and retail growth in March. So this, again, is positive from their standpoint. IMF is projecting 5.2% GDP growth for the year of 2023. We'll know, obviously, later in the year the relevancy of that number, but they're all anticipating at least 5%. On Q1, inflation was mild, and the producer price index for industrial goods actually dropped year on year. And this indicates that the demand has not recovered enough yet to boost prices. The producer price index for industrial products was down 1.6% year on year. Some of the challenges that remain are, one, the debt to GDP ratio is rising. The U.S. FDI reduced their investment significantly in China, though they have other sources that are investing in China from other countries where they're developing it through their Belt and Road Initiative. The unemployment rate is still relatively high, particularly for young people coming out of college at this point in time. Consumer spending has a lot of room for growth, particularly with the urbanization that will continue to occur across the country. Policy adjustments will be likely to help this growth and support the growth. And one of the areas of concern are the home values are declining in many key markets, and the building instruction, which is a key part of the GDP as well. But in any economy, there are pros and cons. So as you see here on my screen, the consumer price index of March here, year to year, was 0.7%, and month to month down 0.3%. So they don't have the high inflation rates that we're seeing today in America and many other countries at this point in time. This is an area people look at across the world in each respective country. This is the manufacturing purchasing manager for index, if you will. And as you'll see here, it's from December through February and just down a little bit in March is very positive. So the outlook they're looking at is positive by the people surveyed. Some of the areas that people are using as barometers for trade across the various countries are, what's happening with the costs of plastic materials generally. And as you can see, starting here and through the respective weeks, we've seen a decline in plastic pricing over the last 1 year period. Crude oil price trend for 1 year, obviously a highly volatile area, but these are international costs, and I believe, at least from press, that China was successful in developing trade agreements with Saudi Arabia and other countries at reduced prices and using the RMB currency. This does two things. One, it reduces their purchasing costs, it reduces their product cost to market. And then secondly, by using their currency, it strengthens their currency against US dollar and other currencies. So both moves are currently in place as they move forward. The steel price trend over 1 year, as you can see, has been downward. There are some peaks in valleys depending on time of year. However, here in China, the construction market has been heavily impacted by COVID and by other factors, funds availability, liquidation, or reorganization of major real estate companies, and therefore the construction side of the business has declined, and therefore the steel prices are affected because China is the largest producer and consumer of steel. Now, iron ore prices are important. If you're into castings and steel and so forth, you can see this is a highly volatile area. There are many trends that impact that, but it can be tracked as well. This is one aspect. This is the primary raw material, but with the steel mills, they're aggressively trying to maintain as much capacity in play as possible to control as best they can the margins, and therefore they'll sell the products with very little profit to maintain their operations and efficiencies. Now, obviously, as part of your strategy, do you stay in China? Do you have a joint strategy where you source from China, Vietnam, and or India, or Japan and Korea? Do you onshore, nearshore, whatever? But I would advise one to think carefully on each of the moves. Part of that decision process is also whether you have markets in China, and when you look at profitability, you look at maintaining those markets, profit from that, as well as your sourcing activities here versus moving a sector of that out. So you want to consider that very carefully. I would encourage you, given the both raw material pricing and the currency swings, to renegotiate your supply agreements now. Currencies have helped to offset the reasonable portion of the tariff, but now is the time to secure those pricing concessions and try to lock those in for a longer period as possible. Suppliers right now are much more willing to extend payment terms and conditions with your help. Obviously, they have to follow the foreign exchange requirements in the country to get their VAT tax back, but those are very open discussions you should have with your suppliers. There is now open capacity at high-quality suppliers for the first time in a while. Let us help you identify, profile, audit, and benchmark the suppliers for and with you. Take a careful look at cost reductions in the design of your products and vertical integration to improve the total cost of ownership, regardless of what country your products are in. Actively monitor the financial sustainability and viability of your existing Chinese suppliers. And we can help provide access to financial reports. And this is very important. Can your suppliers pass a financial stress test? And I would encourage you to submit exclusion requests and make sure your product classifications, HS codes are correct. And by doing this, you can significantly reduce the percentage of tariffs that you're paying, not the 25% max rates, but have it reduced. You can take a look and see what your competitors have done. Have they been successful in appealing it and having exclusion requests? Additionally, study the costs and return and ability to submit those requests, have them approved with Commerce and Customs, and then try to lock those in, which is also very important. But when you go up, you may be very surprised that your competition has already done this. And what you need to do is look carefully at the business case that they provided, provide a similar case to reduce the tariffs on your side as well. When incremental tariffs have ended and or are reduced, make sure that you have proper information with regard to this, and keep close tabs on this with the customs and commerce regulations. If you're choosing to leave China or other markets, you want to think carefully about the NDA enforcements that you have in place, protection of your IP rights. If you have tooling and capital equipment, CapEx in place, can you recover that, remove it, ship it out of country or to other suppliers? Can you justify in your budgets the duplication of this CapEx and or tooling? Because these decisions are not only about long-term returns on investment, but short-term cash requirements to make these decisions and moves. Can you justify duplication of the tooling? Does the operation have markets in China that need to sustain the supply chains and your supply base to your suppliers? Can you find those sub-suppliers also in other countries so you don't need to export components to those countries for assembling your final products? You need to negotiate exit strategies that don't make a competitor out of your suppliers. These discussions need to be open, candid, positive, to try to have an exit strategy should you determine to do so, where you can maintain relationships, protect your IP, protect the capital, enable yourselves to bring out certain equipment, and or maintain markets in the country for alternative products. If you're eliminating or reducing the staff, you need to carefully understand the laws and regulations as it pertains to severance, social benefits, etc. It is believed that India in the future will be, as some people refer to it, the new China supply base. And there are many reasons for that. But India is a major player which has to be considered as part of your. As you know, India has recently taken over from China as the most populous nation in the world. The IMF GDP forecast, as I've noted previously, is 5.9% in 2023 and 6.3% in 2024. It continues to grow and grow proactively. It's also interesting, per the IMF, that India's economy is surpassed that of the United Kingdom in terms of size in 2022. India's exports rose 14% to $770 billion during fiscal year 2023, April to March, and imports rose to a record of $892 billion. So India's active both on exports and imports, not just on exports. India has been very active in negotiating successfully free trade agreements across the world within the past 5-year period. And they offer incentives in the form of tax concessions, rebates. Domestic and foreign businesses are driving ease of business. At a 7.1% unemployment rate, which is actually above pre-pandemic averages, there is a clear need to create manufacturing jobs and plants in India and support from the government. As you can see from this slide on economic development, the CapEx year on year 2023 increased by 35.4%. That indicates significant growth. Also, the total exports was up 44.6% in fiscal versus 2022. This is on various merchandise. Renewable energy capacity has increased. Obviously, they have a lot of work to do in that area, but are focused on trying to address that. Additionally, 320 foreign companies registered in the period of 2018-2021, and they provided for new manufacturing companies in certain areas 15% concessions on tax rates. As you will note, India foreign direct investment, in spite of various restrictions and borders with other countries, has received a record FDI inflow of about $84.8 billion in fiscal year 2022, and about $7.1 billion of that FDI were inflows in the services sector. But as you'll note here, and it's significant that Singapore has been a major investor, and you'll see also that the U.S. is playing an active role, and I think this will grow in the future as well. As you know, the webinar is scheduled for about 1 hour. We're at 54 minutes into the webinar now, so I'd like to provide some conclusions as well. And this is important. There's no one right answer to this historically challenging period. For many, it's Vietnam or India. And there's a logical China plus one strategy also in play, of course. Excitement will continue over Vietnam, but certain segments offer more opportunity than others, given the level of technology currency in place. Of the two, we believe that India will emerge as the next China. You must renegotiate your existing China supply agreements along with currency movement. More suppliers are now willing to extended payment terms, which provides favorable cash flow for your organizations. Request supplier financials regularly. Look at supplier inventories, whether those inventories are positioned here in Asia or in your factories. World-class suppliers now have the capacity that haven't been available for a while. And each of the countries over here also have concerns about a pending recession in the USA and its implications on doing business together. I would like to take this opportunity on behalf of Mark and myself. Mark's on the left, the younger gentleman, and better-looking gentleman as well, our vice president in the States. I've been located here in the room for a long time. We want to thank you for your time, consideration, and interest. And we're looking forward to continuing our discussions together. And we would welcome setting up with your senior management teams joint meetings to consider opportunities here in Asia and how best we could support the success of those opportunities. We're looking forward to continuing our discussions. And again, thank you for the opportunity. Most especially, have a great year ahead.